Good morning, and thank you all for attending today. We look forward to the next hour with you in regards to really two key provisions when we think about how the Inflation Reduction Act impacted manufacturing companies. And so we will be highlighting two key credits today, specifically 45X, which is the Advanced Manufacturing Production Credit, and 48C, which is the Advanced Energy Project Credit, as well as a couple key provisions in regards to these credits around transferability and some of the major changes that occurred within the Inflation Reduction Act. So let's get started. Before we do, I'd like to introduce my co-presenters and teammates. My name is Ron Wainwright. I am the Energy Practice Leader for Cherry Bekaert, and I'm joined today by Tim Doran, who is a director in our energy practice, as well as David Mohimi, who is a manager in our energy practice. And so between the three of us, we'll be covering the topic for today. So let's go ahead and get to the first polling question as we covered the CPE requirements for you. So we are always interested in how did you hear about this webinar? Through a Cherry Bekaert tax advisor, an email from Cherry Bekaert, a friend or a colleague, a Cherry Bekaert alumni, or part of our social media post. And we'll hold the poll open and then we will post the results. Give it a few more minutes for those that may be joining late, just so they capture that first polling question for CPE purposes. All right, let's go ahead and post the results. All right, excellent. So an email from Cherry Bekaert leads the way, but also our social media posts lead the way. So again, we want to thank you for attending today. We hope you find this information very impactful. And there's a lot of energy in this presentation, pun intended. So let's move on. So we wanted to give you some background. Hopefully you've joined some of our prior webinars, but I wanted to cover again, what does the Inflation Reduction Act stand for? And really just give you an overview so that we set really more of a tax policy table for you, and also outline specifically with respect to what was intended within this act by Congress over the next 10 years. So the Inflation Reduction Act, from a historical perspective, was a genesis bipartisan from the House and the Senate. A lot of what we saw was in fact contained, or at least potentially contained, in the pieces of legislation that dealt with Build Back Better. I would comment that it was signed into law August 16th of 2022 on the heels of the Semiconductor or CHIPS Act, which was signed August 9th. And that was very specific, as well as the Inflation Reduction Act, to really drive taxpayers to, one, build and manufacture semiconductor plants in the United States to decrease our reliance on Taiwan. But when you think about the Inflation Reduction Act, 10-year piece of tax legislation in the law, January 1 of 23 became effective, and really includes significant tax credits for clean energy initiatives. So the Inflation Reduction Act, a small piece of legislation of $750+ billion, is really a policy driver towards encouraging, subsidizing, incenting taxpayers, specifically in the manufacturing space, to the two credits we'll talk about today, around clean energy, with the ultimate goal for the country to be carbon neutral by the year 2050. So you may see a lot, and you may already have experience with sustainability type programs. Your company may already have a sustainability leader as well as an ESG leader. And the Inflation Reduction Act on the tax side is to help subsidize and support these initiatives in regards to clean energy, and as well as there were some brief updates from an R&D perspective. So as you think about clean energy, the development, the technology, whether that's hydrogen or whether that's obviously electric type vehicles, there's a recognition event that there will be a lot of startup companies that will be developing new technology or new machinery equipment, or in essence, new processes around clean energy. There really were 4 key revenue raisers in the Inflation Reduction Act, and we won't go into those today, but know that they are impactful because obviously when you think about a 10-year piece of legislation at a substantial cost to the fisc on the heels of the semiconductor, there were some key revenue raisers in there. So next slide, please. So let's kind of dig into it. So what happened in the Inflation Reduction Act? The IRA, as we like to refer to it, not your individual retirement account, but the Inflation Reduction Act, was really introduced intentionally to create new and also expanded other tax credits related to clean energy that we had had in the tax law for a period of time. The most easiest one to point to is the solar credit, which is an ITC credit, which actually began to phase down. And so the Inflation Reduction Act put back to the 30% level and then added to what we say are new and expanded credits, bonus credits, where you could ultimately, in a solar context, a solar array, earn up to 70% credit attributable to the basis of the underlying solar asset. So the IRA really focused on providing incentives. And when we use the term incentives, let's make sure we define it. We define it as a credit. We define it as a deduction. We define it as a rebate or an exemption attributable to renewable and sustainable energy technology. Really what this is intended to do, as I've highlighted in this slide, is to really rebuild the infrastructure of the United States to really be less dependent, obviously, on oil, fossil fuels, et cetera, and be more dependent on clean energy, green energy, whatever term you would like to use in regards to a renewable or a sustainability type scenario, whether that is, quote, wind turbines, which ultimately create production tax credits for taxpayers, or solar or alternative energy, whether that be geothermal, hydroelectric, hydrogen, et cetera. So these technologies, as I've highlighted here, include solar, wind, when you think about a wind turbine, geothermal, I've mentioned, combined heat and power, specifically in regards to power plants. Obviously, what we're looking for is zero emissions. You may have seen there's really been a focus on nuclear power facilities. There's also a focus on carbon capture. So we're trying to bring down and become carbon neutral as a country that follows the Paris Accord in regards to what are called regulated and unregulated carbon emissions. So you'll see, not in this presentation, but there is a 45Q type credit for manufacturers attributable to capturing or sequestering carbon that is being emitted by the manufacturing facility. We are seeing a significant, as well as you may have read, a focus on clean hydrogen, hydrogen being just simply H2O, and basically a bifurcation to create hydrogen, which is a very clean and also a non-combustible type clean energy, as opposed to maybe an electric vehicle having lithium and batteries. There are also very specific credits towards investments in certain manufacturing facilities, i.e. the 45X of an advanced manufacturing production credit and an advanced energy project credit. So we'll kind of touch on that. And there is a lot more. Remember that it was 2,700 plus pages of tax law, permanent in the tax law, for January 1 of 23 through the next 10 years. It is a general expectation bipartisan, that we will continue to see tax legislation in the future in regards to clean or green energy. Next slide, please. So at this juncture, we want to talk about energy tax credits and incentives for manufacturers. Specifically, we are going to start with one of my colleagues, Tim Doran. So I'm going to lateral the football to Tim, and he's going to begin to talk to us about one very specific credit in the statute. So Tim?
Yeah, thanks, Ron. Welcome everybody this morning. Thanks for the introduction, Ron. As he said, my name is Tim Dorn. I'm a director here in our energy credit practice. And we're going to start off by talking about Section 45X, if you would move forward. Oh, well, first we got a polling question. So before we get into 45X, let's do a quick polling question. Has your company taken advantage of any energy tax credits and incentives in the past? And while we get those results, I think I might have seen a question come up about subcomponents with respect to the Inflation Reduction Act of some of these credits that we'll see, and we're gonna talk a little bit about that and hopefully answer that as we go through 45X. I think the short answer is not necessarily in the statute, but we're waiting on a lot of guidance, and we'll talk about that as we go through the code. That's a little over half have not, about a quarter have. Okay, well, we're gonna talk through some of these credits, and maybe they'll be applicable to you. All right, so Section 45X, the Advanced Manufacturing Production Credit, is a little bit unique when we compare it to some of the other kind of meat and potatoes credits that were in the Inflation Reduction Act that, as Ron mentioned, carried forward from a previous regime before we got the act last year. So these are per unit tax credits for different components manufactured that go into ultimate projects or facilities or other clean energy type applications. And as you'll see, each particular component is treated a little bit differently by the code. And there is also a requirement that the component is produced by the taxpayer and then sold to a unrelated third party by the taxpayer. And we'll go through all kind of how the code lays all of that out. The credit amount varies depending upon the type of different eligible component, and how it's calculated varies depending on each particular component. But you know, ultimately these are clean energy production components and storage device components, and we're going to kind of walk through a little bit some examples of each one and then how all of this works. So this slide and the next slide, as you'll see, these are going to be a list. This is pretty much inclusive of all of the different eligible components that the code specifically spells out, but there are, as you see under like applicable critical minerals we'll talk about, there's a long list of different minerals that qualify. And each of these eligible components, and this is a little bit beyond the scope of the talk today, has a particular definition, and it can be very technical in the code. For example, the PV wafer is a photovoltaic wafer, and the code spells out a test that it's a thin slice sheet or layer of semiconductor material of at least 240 square centimeters produced by a single manufacturer directly from molten or evaporated solar grade polysilicon, et cetera, et cetera, et cetera. So for each of these components, you'll want to make sure, if you're looking to qualify for this credit, that you meet the very specific tests that were laid out in the code by Congress. And then we have a separate piece to the right here, and this is what I was mentioning, the metric for determining what our credit is actually varies per each of the component, and is kind of specific to the qualities and nature of the component. So in some instances, we might be measuring our credit based on the weight of the component, based on the dimensions of the component, or based on the capacity of production of the component. So if you want to go to the next slide. So this continues the list. We've got components that go into solar and wind. We've got inverters, fasteners, and then battery type components, and then critical minerals. Now we'll talk a little bit about this, but the two pieces that are a little bit different are the electrode active materials and the critical minerals. Those components, as they're spelled out in the code, are actually calculated for the credit as a percentage of the cost incurred by the taxpayer to produce the materials, which is a little bit different than kind of how the other ones are laid out. All right, eligible component defined. I kind of talked through this. There's technical terms that define each of the components. Generally speaking, they're really based around the kind of content use and capacity for the component. So I talked a little bit about PV wafers. There's another example here from commercial inverters where you can kind of see this. So a commercial inverter, if that component qualifies for the credit, it has to be suitable for commercial or utility scale applications, rated at particular outputs, and have a particular capacity range in order to meet the qualifications and to qualify for claiming the credit. One thing I will note too at this time is and I said it at the outset, a lot of this is based on the statute. There have been some notices from the IRS specific to 45X where we've gotten a little bit of clarification, but we're still waiting on a lot more guidance here. I think, you know, some of the questions around subcomponents or does this qualify, does that qualify, there's going to be a lot more to come. I think the Treasury is going to have to explain some of this stuff because we just don't have the answers to some of those very specific nitpicky questions on some of this really technical stuff. So hopefully that will be coming at the end of the year and into next year. Timing. So these credits are available under the code section for qualifying components produced and sold after December 31st, 2022. The credit does phase out in 25% increments beginning at the end of 2029. So every subsequent year after that, the amount of credit will be reduced, multiplied by that factor until we get to 2033 when there will be no more credit. The credits are not available for components produced in a factory that benefited from the Section 48C credit. So on this presentation today, we're going to walk through 48C a little bit more, and we'll explain a little bit of this kind of cross play between 45X and 48C. But it's important to note that if you're claiming a 48C credit and it interacts with 45X, you can't claim both. They are transferable and eligible for both elective or direct pay, and we're going to talk a little bit about how that regime functions independently as well. So credits can stem from different types of eligible components, meaning a single taxpayer can be producing different eligible components and getting credit for each of those components that are produced. And so your total 45X credit that you will claim on your return is the sum of all the credit amounts for each of the different eligible components. But those components must be produced in the United States. They must be produced and sold to an unrelated party. And the code actually spells out that the unrelated party rules that we're applying here are those under 52B, which is the same rules that apply to the work opportunity tax credit. And we'll explain how those are a little bit different. It kind of swaps in a different controlling percentage for your control group. Another interesting provision is that a person shall be treated as having sold an eligible component to an unrelated person if that eligible component is basically integrated or incorporated into another eligible component and then sold. And what the code saying there is you're still eligible for your component that you're making, even if you're then putting it into another component that's then ultimately sold. And I think an example of that, I mentioned the PV wafer earlier. There's a credit for solar grade polysilicon, and then there's a credit for a photovoltaic wafer. The photovoltaic wafer may use that polysilicon. So if you're producing both, if you're manufacturing both and putting one into the other, you can still claim both of those credits. Next slide. Related party rule. So that Section 52 applies. And I think the big thing to take away here is when you're looking at whether or not you have a related party that you're selling to, that you apply the 50% rule instead of the 80% rule ownership. So the ultimate parent owns more than 50% or a majority of the stock ownership in the party that's being the component is being sold to, then you don't have an unrelated party situation and you wouldn't be eligible for the credit. The Congress wanted to make sure that you are selling these outside of your control group. I mentioned as we were going through the various components that critical minerals are a little bit different. Instead of kind of a credit based upon the components qualities like the weight or size or capacity for production, this is based on the cost incurred to produce the critical minerals. And there is a long list in the code that you can go look up at 45XC6 of all the various eligible minerals that were identified. And it's important to note too that some of those minerals, actually have additional qualifying tests, and those can be a little bit technical. And I put the example in here of aluminum. So it specifically spells out that aluminum only qualifies for the credit if you're converting it from bauxite to a minimum purity of 99% aluminum by mass, or purified to a minimum purity of 99.9% aluminum by mass as part of your production process. So that interaction with 48C that we're going to talk about a little bit more, 48C is determined at the facility level, and David's going to walk us through how that all of that works. But when you're looking at the interaction between 45X and 48C, if you're qualifying for 48C and claiming a 48C credit at that facility level, and that facility is producing some of these eligible components, you can't claim both. It's an either or situation. But if you have a larger manufacturing site where you have different production units that are separate facilities, you can claim 45X on components coming out of one facility and 48C on a separate facility. So the code does not look to the manufacturing site of production. It looks to the production unit that's making these components. All right, so these credits qualify for a scheme called elected pay, and I'm going to turn it over to Ron to kind of walk us through how that works.
Sounds great. Thank you, Tim. So one of the key paradigm shifts that occurred in the Inflation Reduction Act is really dealing with how credits can be monetized and utilized by taxpayers who may not generate the credit. So at a very high level, there are really two key provisions that we're going to talk about. Is elected pay, which means that you as a taxpayer, to the extent that you qualify as a claimant, which are very specified terms in the statute. So when we think about maybe a project that's being co-developed on American Native land, that could be an elective pay credit. And then we'll talk about this elective pay being 6417 of the statute. And then we're going to talk about what are referred to as the transferability provisions, which is 6418. So what does elective pay do? It really makes certain clean energy tax credits refundable. Refundable being the government, to the extent that you qualify, will write the check for the credit that is being generated. So how do you claim that? The claimant has to, one, notify the IRS of their intent to request the refund from the government. The claimant has to file its annual tax return to claim the elective pay provision. And then ultimately the government or the IRS pays that claimant 100% of the value of the credit. So remember that historically, when you think about, quote, energy credits, there were structured finance type vehicles that were put in place, a flip transaction, a sale leaseback, an inverted lease, whereby tax equity investors or taxpayers who were interested in purchasing credits coupled with depreciation of the asset would enter into this structured finance vehicle and ultimately be the recipient of that credit and depreciation, even though they did not develop that asset and place it in service. So elective pay, again, under 6417. And let me just kind of walk through, because these are the same credits that when we talk about transferability attributable to the developer and ultimately the owner can sell the credit. So let's think about Section 48. So Section 48 is very broad. It's ultimately called the energy credit. And let me also pause. So when you think about all of these credits, again, as Tim highlighted, we're still waiting for guidance. We've received some interim guidance from the IRS, but we are waiting for guidance when we get to transferability just this month on how does that work, and I'll speak to that. But keep in the back of your mind around all these 2,700 pages is you really have two types of credits that could be elective pay and or transferred. And I mentioned Section 48. So when we think about Section 48, that is really an investment tax credit. So you have two pillars within the statute. You have Section 45, which has got a lot of credits in there, but those are production tax credits. That's where ultimately, as Tim was mentioning, 45X, you're producing something, and therefore, because of the production, it could be in a subcomponent level, you're earning, quote, a production credit. If it's Section 48, that is referred to as an investment tax credit. That credit is earned based upon not the production, but it's based on the ultimate basis of the underlying asset. So we'll just kind of go through these very quickly to give you a sense of Section 48 and Section 45 type credits that can be eligible for elective pay and or transferability. And you'll begin to, I think, really understand what Congress in this paradigm shift was attempting to accomplish, which was basically effective January 1, 2023. You no longer had to go through the, quote, structured finance type vehicles. Now, we're only dealing with credits, not dealing with the depreciation. So elective pay is purchase the credit from the IRS or government. Transferability is purchased from the ultimate developer or the generator who wants to sell that credit, if you will. So Section 48 is an energy credit. There are multiple provisions in there. 48 Cap C is what's referred to as the Qualified Advanced Energy Production Credit. The Section 48E is the Clean Energy or Clean Electricity Credit. Section 45 is the Renewable Electricity Credit. Section 45U is what's referred to as the zero emissions. That's that nuclear comment that I made. So you want to kind of get to that zero emission standard of 45U. And then you've got carbon sequestration, 45Q, which I mentioned. You've got Section 45V. That's more clean hydrogen. That's where we see a significant amount of, I'll say, focus and technology currently. You have Section 45W, which is around the clean vehicle credit. Advanced manufacturing production credit is 45X. Clean electricity production is 45Y. 45Z is clean fuel. And then ultimately Section 30C is the alternative fuel vehicle refueling type credit. So just to kind of lay some foundation, but these are the identical credits that are eligible for elective pay or transferability. So let's dig into transferability a little bit. But before that, the polling question. Are you aware that certain energy tax credits can be transferred to an unrelated taxpayer for cash? Yes, no, not sure what this is. We'll give you all a few minutes. All right, let's go ahead and post those results. All right, yes, well, that's a great answer. 46% just nudged out the no's, and we have some that are just not sure what this is. So again, this is a significant paradigm shift in regards to what can occur to the extent of clean energy or sustainability type credits, to the extent you qualify for the direct pay. Obviously, we kind of covered that quickly. That's a very specialized group of taxpayers. The broader audience that we see being really is the Internal Revenue Code Section 6418. So next slide, please. So go back one. So what does 6418 tell us? Basically, it tells us that it allows an entity not eligible to use the elected pay, because those are very specified entities, to transfer or sale all or a portion of the eligible credit that they are, in essence, the developer are generating to an unrelated transferee for cash. I won't go through all the credits eligible for transferability, but you will notice that the slide mirrors the direct pay in regards to whether it's the Section 48 credit or all the way down to the alternative fuel vehicle refueling credit. But these credits can be transferred or sold under 6418. Next slide. So how does that work? So under the proposed regulations, a transfer election must be made by the taxpayer for a specified portion of the single eligible credit property. And that is what we're looking and waiting on guidance for, is in 2023, if a taxpayer is interested in transferring or selling that credit, what's the mechanism that the IRS is prescribing? So we saw some interim guidance telling us that this would come out in October. We have not seen it yet, but it's important to understand around these transferability provisions that the IRS will be monitoring pursuant to the election that will be within the tax return and identifying the credit that is to be transferred from the seller to the purchaser. So basically what happens is you get a pre-filing registration process and obtaining a registration number that's on the quote seller for each eligible credit property, which is going to be covered underneath what's called the transfer election. We're still waiting on the mechanism here. But the taxpayer who is interested in quote transferring the credit must make the election on a timely filed original return for which the credit has been determined, whether that's Section 48 or that's Section 45. And then consideration has to be made or paid by the transferee in cash. That is critical. So there's no payments and notes, equity interest, property. That is a pure cash transaction. So next slide. So the cash consideration, and this is very important, because there are now exchanges that are beginning to develop because it'll be over a 10-year period of time. But the transferee, the seller of the credit under 6418, is not going to include the income recognition event upon transferring that credit. Simultaneously, as we pointed out here, the payment is not deducted by the transferee. So think about what's going to happen in an arbitrage situation, because these credits will be discounted. So what we're seeing right now is an example in 6418 underneath solar, or majority of specific credits, 45Q is eligible, et cetera, the ones I highlighted, is it's usually a market of about 80% to 85%. So a 20% to about a 15% discount. Obviously, it is a demand and supply type scenario for those that are interested in acquiring these credits in 2023. I think the later in the year you acquire, that arbitrage is going to contract. Very important point. So as to stop the kind of mill, the transferee cannot retransfer the credit to another party. Once made, again, the transfer election is irrevocable by the taxpayer that ultimately generated the credit. So a couple key things to keep in mind. So what are we saying in transferability of market? We are seeing that we're still looking for new rules surrounding the specifics of the transferability that I covered, but marketplaces, as I mentioned, are developing for credit sellers and buyers to connect on an exchange. If you're interested in that, post this presentation. We know of a number of exchanges, and we've actually helped some of them. Probably one of the most critical pieces, if you are a purchaser of credits, you want to buy down your tax liability by acquiring a credit that is transferable, is going to be, well, what is the quality of the credit? How do I determine the accuracy of, let's assume, solar? Do I get a 30% credit, or am I eligible for the bonus credits around U.S. components, or am I in, is that asset in an energy community, or do I happen to be in a low income community? Because, credit can go from 30 upwards of 70%, depending on those questions, as well as prevailing wage and apprenticeship type requirements, which is also an element, which we do not have time to talk. But if you're a purchaser or a transferor, the quality of the credit is going to be very critical. It's like a due diligence scenario. So while some of the exchanges actually are active, we know of a couple that are active, actually credits are being posted, there have not been any today that a transaction has actually occurred. So just to be clear on that, I think there will be a lot of activity. I know there will be a lot of activity once we see guidance that exchanges that are up and running, but there has been no transactions that has occurred across the United States or in regards to the transferability provisions. Obviously, direct pay is an entirely different question because that comes from the government. The marketplaces also are expected to allow transactions to occur a lot in November and a lot in December, subject to the guidance. So, next slide. So we're going to go to section 48C. I had mentioned that. That's the Advanced Energy Project Credit. And I'm going to turn that over to my teammate, David, who's going to walk us through the 48C credit. David?
Thank you, Ron. Yep, as Ron mentioned, I'm Dave Mohamani. I'm a manager within our renewable energy practice, and I'll be talking about the Section 48C Advanced Energy Project Credit. Okay, so 48C was around before the IRA, but what the IRA did was extend the credit and also expand what could be eligible for the credit. So there's basically three types of energy projects that are going to be applicable for 48C. The first is going to be projects to re-equip, expand, or establish an industrial manufacturing facility which produces or recycles products listed in the code. The second of which is going to be projects to build or re-equip an industrial manufacturing facility with equipment to reduce greenhouse gas emissions by 20%. And last of all, we're going to have projects to re-equip, expand, or establish an industrial facility for the processing, refining, recycling of critical materials, which is defined in Section 7002A of the Energy Act of 2020. Okay, now here we have a list of the category 1 projects. As you can see, what's qualifying as a production recycling facilities. So you have property designed to produce energy from the sun, water, wind, geothermal, fuel cells, micro turbines, energy storage. So all these different things will be eligible under the category 1 projects. There we go. Okay. Then we have section 2. These are the projects that are aiming to reduce greenhouse gas emissions by 20% or more. And that's going to be through the installation of things like lower zero carbon process heat systems, carbon capture, which we discussed briefly before, the transport and utilization and storage systems of carbon, energy efficiency and reduction in waste from industrial process, and then any other industrial technology designed to reduce greenhouse gas emissions as determined by the IRS. Okay, then we have our category 3 here, which is the critical material. So what that means is any non-fuel mineral, element, substance, or material that has a high risk of supply chain disruption. Obviously, supply chain disruption is a hot topic these days with the way the world's going. And then another component is serves as an essential function in one or more energy technologies, including technologies that produce, transmit, and store and conserve energy, as well as critical minerals. The Department of Energy publishes an annual list on its website of what qualifies as critical materials and minerals. So different than 45X, 48C is actually going to be an application-based credit. So we're going to go through the application process later. It's quite involved. And there was about $10 billion given to 48C with the IRA. About 40% of that is earmarked for projects that qualify to be in a low energy community, an energy community. We're going to talk about what that is. The base credit rate is 6% of the qualified investment. But if certain requirements are met for prevailing wage and apprenticeship, then you're going to go up to a 30% base credit rate. So energy communities, that's defined in IRS Notice 2023-29. So those are going to be brownfield sites, communities involved in the extraction, processing, transport, or storage of coal, oil, or natural gas. Communities with an unemployment rate at or above the national average for the previous year. A census tract where a coal mine closed after 1999, or a coal-fired electric generating unit was retired after 2009. If you go to the Department of Energy, they actually have a mapping tool, which we use quite frequently, where you can just type in the address of a certain project where it's going to be, and it shows you a nice little color-coded map as to whether or not it's in an energy community or not. Okay, now we're going to get into the prevailing wages and apprenticeship requirements. So labor and wages, this is under IRS Notice 2022-61, the historic application of begun construction. Prevailing wage really is going to be the combination of a basic hourly wage rate and any fringe benefit rates paid to workers in a specific classification of labor or mechanic in your area for construction, alteration, or repair of the project. So meeting the wage requirements and maintaining and preserving sufficient records for establishing that you are paying a prevailing wage. So the DOL, Department of Labor, publishes the prevailing wage on their website. And what you're going to see is they have different classifications for different types of workers that are going to be involved in a project. You type in, the address of your project again, and you can see based on the type of work that's being performed, what a prevailing wage in that area is considered to make sure that you are paying prevailing wage to meet this requirement. That way you can get the credit rate from the 6% up to the 30%, like was mentioned before. Okay, so apprenticeship. IRS Notice 2022-61 clarifies that the requirement is met when labor hourments required in the IRA are met, apprenticeship participation requirements in the IRA are met, and record keeping requirements are met. There is a good faith effort exception. What we mean by this is if you prove that you applied for apprenticeship or reached out and tried to enroll in one of these apprenticeships, and you have sufficient documentation stating that, but we're unable to, locate qualified apprentices for your specific project, then a good faith effort exception can be given to you, but you have to prove that you've at least made an effort of some sort to get these apprentices as part of the project. So the apprenticeship requirements, so based on when the project is placed into, or the construction begins, the percentage of hours that qualified apprentices are going to have to work changes. So anything after December 31st, which is mostly what we're looking at here, is going to be 15% of the total hours of the construction project were done by qualified apprentices. As it comes down to the wage and apprenticeship. And again, if you meet these requirements for both the prevailing wage and the apprenticeship, that's when you're going to get that 30% credit rate. Okay, then we get to the application process. I'm going to turn this back over to Ron to walk you guys through the application process.
Thank you, David. So in regards to the 48C credit, we want to make sure that you understand where we stand right now in the application process. And so the first round of allocations consisted of $4 billion of what was allocated, of $1.6 billion, which were allocated to those projects located in energy communities. Remember, an energy community could be deemed to be more of a coal type community that saw a shutdown, or so that is often what we refer to as the Joe Manchin provision with respect to the 48C. But the application process, so the first round did expire July 31st of 2023. It was opened in May, closed in July. And again, it's a $4 billion allocation towards these advanced energy projects. The application process is not straightforward. It is not straightforward. So we expect to see more guidance from the Internal Revenue Service, and I'll give you an update of where we sit currently. So the application process really consists of a two-step process. The first for those that did apply prior to July 31 of 23, is you must submit what is referred to as a concept paper. And then ultimately, if you're selected, then you will submit what is called the 48 Cap CE program application. And obviously, all of this runs through the Department of Energy. What we have heard and what we have seen pursuant to the IRS is that when this first round, they expect to make their decisions, and they gave us this guidance under 2023-44, is that we will see those first concept awards by March 1 of 2024. So concept papers are still being reviewed by DOE. Next slide. All right, so the application process specifically. The taxpayers are required to submit, again, the concept paper, which is really just what is the concept that you are going to accomplish. And you have to submit that through the exchange portal to the DOE, and that must be an online concept application paper. So what does the concept paper do? And what does the concept paper tell the Department of Energy so that they can kind of make their determination? It really describes the proposed project. And it ultimately is used by DOE, and they're in this evaluation period, to evaluate the proposed project in connection with the parameters or the eligibility under 48 Cap C that David covered. So again, the first round of 48C expired July 31 of 2023, i.e. the concept papers were required to be submitted no later. And as I mentioned, 2023-44 tells us that they will, and that is guidance that says they will have made their determinations and concept papers will be selected no later than March 1 of 2024. Next slide. So again, a little bit deeper. Again, DOE is going to issue a letter to the taxpayer encouraging or discouraging the taxpayer from submitting the application, again, based on the concept. All taxpayers, however, that submit a concept paper by the deadline may continue and submit an application irrespective of the DOE's initial response. So just because you get a discouraging letter does not mean that they will not in the subsequent period award. So that's kind of one of these, interim guidance. They're just kind of giving you a little bit of a encouragement or a discouragement based on what their evaluation was. The taxpayers that submit for the credit application, the DOE will make the recommendation as to whether to accept or reject the application. And then hopefully they provide a ranking of the submitted applications to the IRS for the awards. And remember, the first award out of the $10 billion is $4 billion. And then we will expect guidance around the second tranche of concept papers. And we will expect and do expect that the process or the application process is going to change based on the learnings of the Department of Energy around kind of that first tranche of $4 billion. Next slide, please. So again, the DOE reviews it, confirms the project's qualification under 48 Cap C, applies evaluation or other criteria. That other criteria is what is unknown for ultimately the allocation of the 48C credit. But I think basically DOE will consider the analysis of the commercial viability of the project. What's the potential domestic job creation? So that's where that prevailing wage and apprenticeship requirement was kind of one of the foundational elements attributable to the Inflation Reduction Act, because that was a policy to really create jobs in regards to ensuring that projects across the clean energy spectrum, if you weren't grandfathered, i.e. you didn't have kind of shovels in the ground by January 30th of 2023 on a project, then you're underneath what David covered, which was in essence the prevailing wage and apprenticeship requirements, where that project must meet those requirements. So again, potential domestic job creation, that's going to be specifically evaluated where in fact is that project or that asset being constructed when we think about an advanced manufacturing type scenario. The The potential net environment impact is going to be important. And ultimately, what's the potential technological innovation of that project, i.e. the concept paper. And then ultimately, one of the things I think we're going to see is what's the completion timeline? What specifically is the completion timeline in regards to, is it going to go in service in quote 2025? Is it a 2024? Is it 2026? Because remember the 48C was in the statute. And what happened since it had been in the statute is that the demand and application process outstripped the funding. And what happened in the Inflation Reduction Act was they evaluated, being Congress, what was the volume of applications that we had received underneath the old regime, and it was $10 billion. And so that's why that $10 billion mark is there. Next slide, please. So again, the IRS makes their final determination regarding kind of encouragement, discouragement, acceptance or rejection of the application. Obviously, they will provide some feedback in their encouragement or discouragement, and they will notify the submitting taxpayer, as I said, prior to March 1 of 2024. Ultimately, if your application is accepted, assuming some on this call, but if you are interested in it, then obviously we are here to help you in the second tranche. And I would expect that second tranche application, very similar to the first tranche, to probably open up in the May of 24, and probably, depending on their learnings, close in the July and August timetable of 2024. So if your application is accepted, then that will then, the allocation letter ultimately setting forth the allocation of the credits to the applicable project once you've gone through the second step of the application process. But we wanted to cover this today because this is very, very important to make sure that if you are interested in applying for the $10 billion, which was, again, when you look at old law, that was the total number of applications that they received for potential funding. And of course, they outstripped the old law because that old law was about $4 billion that had been allocated. So now it's $10 billion. Next slide. So again, within 2 years of receiving the allocation letter, the taxpayer has to notify the DOE that applicable certification requirements have been met. So there is a complicated, process, if you will, of which DOE ultimately provides the confirmation to the taxpayer and the IRS. The IRS will then certify the project by providing what's called a certification letter. And then ultimately and finally, the taxpayer has to notify the DOE that the project has been placed in service within the 2 years following the issuance of the certification letter. So that's very important to understand, as they are a tight window here. And that's why, in the concept paper, when are you going to be able to deliver? Can you do it, once you receive it in 2 years or 3 years? And then again, the timeline for the second round of funding and applications has not yet been announced. But I would say that I would expect a similar concept to 2024 that we saw in 2023. A little bit of a tight window from May to July, probably will be expanded a little bit, but it'll be the same process. And then I would expect post March 1st, we're going to see what were the learnings of DOE in regards to the concept papers, and give us a little bit more guidance, as I covered in the slide, as to what they're looking for specifically. And again, all of this is to drive, obviously, clean and green energy for the United States. Next slide. So as a point of comparison, next slide. So again, summary of Section 45X and Section 48C. So 45X is earned over time based on the production and the sales specifically of eligible components. Therefore, it's called the production tax credit, or PTC, because that's going to be, to the extent you qualify, that you're going to earn it over time. 48C is ultimately an upfront credit, and it's all based on the capital investment of that industrial or that manufacturing facility based on the concept paper. And ultimately, it will not vary by how much product or facility produced or sells from that standpoint. Again, 45X earned over time, 48C upfront tax credit. 48C, $10 billion is no small sum. As I mentioned, ultimately they want a specific amount of projects going into, kind of those areas, those energy communities, if you will, that have been shut down from a coal perspective. Both credits, remember to the transferability, other 6417, if you happen to be, and you meet those criteria, which we did not have time to cover, or transferability under section 6418, 6417 direct pay, 6418 transferability. Both credits are eligible, in essence, for direct pay and transferability, 45X and 48C. However, projects cannot claim both. It's very important. We do a lot of the modeling and analysis when you think about, whether it's a production tax credit, analysis on a solar array over time, or whether it's kind of just the original credit. So remember that ITC and PTCs are really mutually exclusive. You cannot claim both. However, the components are made at the facility that claim the 48C credit. Manufacturers cannot also claim the 45X. So that was just something that we've seen a lot of questions in that regime, if you will. Next slide. So this brings us to our final polling question. We always want to be respectful of time. We have about 2 minutes. Would you like to learn more about how to take advantage of 45X or 48C, or do you have other questions that you may be considering as a taxpayer that we could assist with? Yes, no, maybe in the future. Give you a little bit more time. Make sure those that get the last polling question for CPE purposes to our initial announcement. And we hope there will be a lot of yeses as we do ultimately assessment, identification, and quantification in our discussions with our clients, as well as hopefully potential clients. So I would encourage you, to the extent that you have any questions, to please reach out. As always, I want to thank my fellow teammates and Tim and David for co-presenting today, but we would welcome the opportunity to interact with you. And so we greatly appreciate your attendance today. So again, thank you for attending our webinar today, and have a great day. Thank you.